Welcome to our latest client communication initiative, Meet the Managers, where you will hear directly from the fund managers managing money as part of your diversified portfolio. Each podcast will be around 10 to 15 minutes in length and is subject to the following disclaimer. This presentation is prepared by SWU Financial Planning and is general information only and does not constitute a prospectus, an offer, or an invitation to subscribe to any securities or advice in relation to any securities or financial products. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. The comments contained herein are expressions of belief only and should not be relied upon as authoritative or without the recipient's own independent verification or in substitution for the exercise of judgment by any recipient and are subject to change without notice. SWU Financial Planning is the trading name of SWU Financial Planning Pty Limited, who is a corporate authorised representative of Australian Unity Personal Financial Services, Australian Financial Services Licence Number 234459. The information is taken from sources which are believed to be accurate at the time, but neither SWU Financial Planning, Australian Unity Personal Financial Services, nor any of its related parties, its directors or employees provide warranty of accuracy or reliability in relation to information contained in this presentation or accepts liability to any person who relies on it. Past performance is no indication of future performance. Unless expressly stated, none of the information should be taken to be a recommendation. Investors should consider the product disclosure statement relating to each fund in deciding whether to acquire or continue to hold units in the fund. We hope you enjoyed today's podcast. So good afternoon, everybody, and welcome to another episode of our Meet the Manager series during the COVID-19 pandemic, where we bring our fund managers straight to your devices to get an insight as to how they're managing investments on your behalf. And today I'm very privileged to have Chris Andrews, who is the Chief Investment Officer of Trobe Financial. And Chris has over 21 years of industry experience, and he first joined Trobe back in 2006 in the role as legal counsel, and then has headed the credit fund, which is the fund that a lot of you are exposed to in 2009, and then formally became CIO in 2015. So Chris brings a lot of experience and a lot of history, I guess, to share those insights with us today. So Chris, thanks for joining us today.
It's a pleasure to be with you, Jonathan.
So getting straight into it. So Chris, we've been allocating monies to your flagship strategy, which is the Australian Credit Fund, for a number of years now. We've been really, really happy with the performance. In a nutshell, how do you invest our clients' monies, and what are you actually trying to achieve?
Thanks, Jonathan. Good question. And look, we really appreciate your interest and support, and of course that of your investors over many years now. We are really aware of how difficult it is for investors at the moment to obtain reliable income, and how damaging the capital volatility that we are seeing in markets at the moment, how damaging that can be. We know that market volatility, low interest rates, the dividend cuts that markets are now talking about, that's a really difficult environment for investors. We're really pleased that we can be part of the solution. In our view, times like these really showcase, if you like, the value of our approach to investment. So we started in 1952. Our conviction is that granular credit exposures, by which I'm talking about home loans, small commercial loans, exposures like that, always secured by a first-ranking registered mortgage over property with collateral margin for safety, that is a really incredibly resilient form of exposure for investors, resilient to market volatility and to economic downturns. The intuitive sense behind that, of course, is if you look at investment markets, you see stocks, bonds too. Those prices are driven fundamentally by investor demand. In an economic crunch, a person can always sell their portfolio, their stocks or their bonds, but their family home, their business premises, that's a different kettle of fish. They still need somewhere to live and work even in difficult times. So that's the fundamental dynamic we're looking to capture. Highly diversified portfolios of small loans, residential and commercial, as I said, secured by first-ranking mortgages at low loan-to-value ratios. Our portfolio average is just 63%. So we utilise that dynamic to deliver capital stability and consistent monthly income. So that's sort of, if you like, the story of Trobe Financial over 7 decades. In all of our portfolio offerings, so our institutional offerings, because we run funds also for some of the largest financial institutions in Australia and the world.
Mm-hmm.
We take that same approach, and in all of those portfolio offerings, so whether those institutional mandates are in our 48-hour, 90-day, 12-month or 4-year accounts, we've never lost a cent of investor capital. We've never had to withhold a monthly distribution. And we've always returned capital to investors at maturity without exception.
Mm.
That's what we're most proud of as an organisation. That's the achievement that we're most proud of. But that's also what we are really fundamentally committed to delivering for investors, not just now when times are difficult, but also, into the future for many decades to come.
Yes, because this is not the first crisis you've seen. There's going to be further crisis down the track. What we've seen with COVID-19 is clearly the pure definition of a black swan event. And with the attractive level of income that you provide to investors, a lot of clients do come back to us and say, well, Jonathan, you keep reminding us this is not a term deposit and La Trobe is not a bank. And we keep reminding clients of that. And they say, ultimately, La Trobe is lending money to regular Australians who want to buy property or small business and or construction loans and things like that. Why would investors be willing to borrow money off you at such high rates? And then the natural question that most people think from a bank's perspective would go, well, if you're charging really high interest, then the borrowers must be bad.
Terrific question. Yeah, no, really good question, Jonathan. Look, our investment strategy is built around targeting borrowers who actually don't get good service from the mainstream banks.
Mm.
We're assessing their applications manually, so that's a full manual assessment, if you like, rather than an automated ticker box approach that you see at a lot of the big banks. Likewise, we're sending an independent valuer out to the security property to manually assess it, rather than sort of relying on the automated desktop valuation methods that are available these days. Our borrowers pay a premium for that service, and that's what drives the consistent yields that we've delivered for our investors over 7 decades and across multiple economic cycles. We're really proud of the quality of our borrowers. I think, Jonathan, I would offer to you that we provide the most detailed monthly reporting almost in the funds management industry. So we provide full transparency as to what those portfolios look like. You and your investors can see that on our website at latrobefinancial.com. Just to pick a few key data points for our 12-month term account from our most recent end of March report, you can see that our average loan-to-value ratio is just 63.4%. Another way of looking at that is that we have $158 in real property assets securing every $100 lent. It also means that borrowers have on average 36.6% equity at risk in every loan. So it's a real high quality borrower cohort that has lots of skin in the game, if you like.
Mm-hmm.
We've got 92% of our borrowers with 0 credit events on their credit history. 89% of our borrowers are rated A on our internal risk grade, and 84% of our borrowers have an Equifax score of good or higher. That's important, of course, because it's an external, if you like, external third-party data point confirming the quality of our borrower cohort. But, most fundamentally, these are the borrowers whose performance over many decades has driven the incredibly stable return profile that we've delivered for you and for your investors.
Ultimately, that goes back to the long time tested theory of, you pay for what you get. And, there's always a more expensive product or service in the market. And, people are willing to take part in that part of the market if they see the value in what they get. So obviously, La Trobe, with you at the helm and the 7 decades worth of experience has certainly, been tested through many, many rough patches.
Exactly, Jonathan. Yeah.
With the COVID-19 pandemic, unfolding, and I forgot to mention that today is Tuesday, the 21st of April. probably
It
the
is.
longest 2 months of our careers.
Longest 2 weeks, Jonathan.
Or longest 2 weeks. Yes, very much so. There's been this unfolding narrative around owners, and obviously some of those are investors in property, not being able to pay their mortgage off, losing their jobs, then having to go through, job seeker or job keeper if their employer is applying for that. I mean, how has this sort of dynamic been playing out in the strategy?
Yeah, another really good question. You're getting right to the heart of it today, as you always do, Jonathan. Look, going into this pandemic crisis, our arrears levels are low. Actually, quite unusually low at this time of the year. We are, of course, and as you've outlined really well, we are expecting increased levels of borrower hardship now. Like all lenders, we have standardised hardship assistance programs. So the point of those is obviously to assist borrowers through this hibernation phase, if we can call it that the economy is currently in. Our latest assessment is that approved hardship cases represent about 7.5% of our portfolio by dollar. But we're also, and you mentioned the JobKeeper package, we are seeing hardship applications really drop quite dramatically since late March on the back first of the JobKeeper package, but also the early access to super package that the government launched at the end of March. Both of those policies are having a really material and helpful impact on hardship levels amongst our borrowers. Now, having said that, like any prudent manager, we do a lot of stress testing around these issues in particular. So our portfolio managers are running daily a range of stress test scenarios around our portfolios. One of those which we've run recently is we ran a stress test on a scenario in which 25% of the portfolio is unable to make repayments. And importantly,
Wow.
too, this is the variable that people often leave aside. That level of hardship in that stress test that we conducted actually peaks in December before it gets any better. Now, that scenario is a few orders of magnitude more severe than any that any mainstream economist is projecting at the moment, both in terms of the levels of hardship, but also the length of the episode. Even at those levels, our modelling shows that we could really comfortably support the current distribution rate of the 12-month term account. So while we're very watchful of economic developments over the next 3 to 6 months, and we're going to continue stress testing, we're going to continue looking at our portfolio really carefully, our collections teams working very, very closely with all of our borrowers, we're comfortable that we've got our portfolio really well positioned to continue to deliver for investors in the months ahead.
No, that's fantastic. I mean, stress testing, especially on strategies like the ones that you run, I mean, is critical. And at times like this, it's whether it be you're a business and you're stress testing your ability to continue to operate, or versus we're being in the funds management and advice sort of industries, and whether or not we can continue to generate those returns. I mean, stress testing and bringing forward those sort of concerns and see what the limits are for funds like yourselves is critical. So thanks for sharing that with us.
I'm more than happy to.
So during the GFC, and this is sort of the last question, we saw that one of the risks that unfolded was a run on the banks, and subsequently a run on funds, where everyone was redeeming and forcing fund managers to fire sale assets. I mean, there's a very unique sort of element with regards to your funds. I mean, we saw during the GFC that there were funds that were sort of masked and providing, within inverted commas, daily liquidity, but in actual fact, they couldn't if they were sort of pushed to the corner, into one corner, and just forced to sell assets, which is, of course, as we know, a detriment to investors over the long term, and especially those ones that want to stay in a strategy. So, from your perspective and from the fund that you're running, do you consider this a risk this time round, and how is that relevant to what you do?
You're going right to the heart of all the most topical issues, Jonathan. So, look, when we had the same management team in place through the global financial crisis, and as you said, we were sort of one of the few managers really in our space to come through without having to put any gates or restrictions around liquidity, and as well being able to deliver for investors full capital return and ongoing monthly income through that period. Having seen it up close, let me make the following observations. Firstly, our banks and our banking system is better capitalised, better regulated and more robust than in 2007, 2008. That has knock-on benefits in our view for the whole financial system and for the whole economy, certainly in terms of confidence. Secondly, in our view, fund managers generally have a better handle on liquidity risk than they did pre-GFC. Some of the more obviously deficient structures of the sort you're referring to there, Jonathan, they're no longer prevalent. The final sort of high-level observation is that our governments and regulators, they've clearly absorbed all the lessons of the GFC and they are proceeding in an incredibly coordinated and targeted response. You know, we said in one of our investor briefings about a month or so ago that, and this seems incredible, that the GFC might end up being seen as a dress rehearsal for the coronavirus crisis, at least in terms of regulatory responses. That notion's been picked up by a few commentators since, and there is a real truth to it without in any way downplaying the pain caused to many investors by the GFC. So on balance, the view is, our view is certainly that the economy is better placed than pre-GFC. That being said, we are anticipating some substantial economic hardship to come, which at the moment it doesn't look to us like markets are properly pricing in. So that sort of backdrop in our experience always shines lights on those managers who aren't on top of their games, particularly in relation to liquidity management. Our approach, and I say this strategically but also philosophically, our approach at these times in the market is always to tilt towards cash, particularly in our short-dated accounts. So I referred to our 48-hour account before, for example. We dialed that up to 87% cash at the end of March.
Wow.
Our 90-day account, we dialed up to 33% cash. We're expecting to hold this type of elevated level of cash for some time to come. In fact, our Chief Liquidity Officer, Gary Bell, he actually ran liquidity risk for the National Australia Bank during the GFC. So we've got lots of experienced eyes on this important issue, and we have some really bedrock philosophical approaches to liquidity management at these times in the market. Partly that's arising from our experience in the GFC, and that has taught us that to be overweight cash at these moments is a really, really strong position for a manager.
That's fantastic. And I mean, that's also the cornerstone reason why, from our, investors that have direct investment with La Trobe outside of platform, I mean, it is a 12-month account. And that's also one of the key hallmarks of how, I guess, your team manages that liquidity profile and requirements, because you already know what you may have to pay out or which investors have, other needs for their money after the end of 12-month period. And we always, reflect this sort of strategy with our clients and say, while you know that your money is, there for 12 months, you have more certainty at the back end that you can control your own liquidity profile across many other different assets and investments that you may partake in. And you know that in 12 months' time, you can apply for that money to come back. And Chris, I think I heard you just say that in the history, you have never not been able to pay back the investor's money.
Yeah, that's correct, Jonathan. And the points you're making are absolutely right. The 12-month term, well, firstly gives us certainty of funding, and that's critical so that we can meet redemptions as and when they fall due. So that's an important part of the discipline. And really, managers who aren't paying attention to asset liability matching are asking for difficulties in these sorts of times, which look, they don't come along that frequently. But when they do, investors and managers and really the whole economy wishes everyone had paid more attention to these really fundamental issues. And asset liability matching is at the heart of our strategy.
Yeah, no, that's fantastic. So, Chris, thanks very much for joining us on the podcast today. Continue up with your great work along with your team. I know times continue to be uncertain, but we thank you for being prudent managers of our clients' funds.
Wonderful, Jonathan. Wonderful to talk to you and your investors, and we look forward to working with you for many years to come.
Thanks, Chris.
Thanks so much. Goodbye.
Remember that this fund forms only one part of a well-diversified portfolio and should not be invested in isolation, as each strategy has unique characteristics which interact with other funds within your portfolio. If you require any further information, please contact your financial advisor at the SWU Group on Sydney 02 9211 0228.